Hey everyone, so a couple of weeks ago I asked my subscribers what video topics you guys would like to see in the year 2021 because I want to make a particular effort this year of making content that you want to specifically see. So if you have any further topics, you can always jump over to the community board on YouTube and leave your topics there. I'll be drawing on that throughout the year. But one particular subscriber suggested that I should take a look and break down Berkshire Hathaway's letters to the shareholders written by Warren Buffett over the past 40 years and break down some of the investing principles that he discusses in each of them. And I think that is an excellent idea because I have read through all of these multiple times and there is tons and tons of very, very valuable investing lessons embedded in all of these. So I think that would make a valuable video series to go through each of them. Today, we are going to be taking a look at the 1977 Berkshire Hathaway Letter to the Shareholders, written, of course, by Warren Buffett in early 1978. And for those who are not aware what these letters to the shareholders are, these are essentially an annual letter usually written either by the CEO or the chairman of the board of that particular company. And most of the time, for most public companies, these letters are absolutely useless. Most of the time, they are really short and they just provide all of the positive things that happened to the business that year. And to be honest, a lot of them sound like some kind of sales pitch to attract new investors to invest in that company. Occasionally, if the company is run by a highly competent management team, then these letters will be a very transparent and realistic view of the business's performance in that year, but also over the long term, so that you can get a good insight into the good things and the bad things happening with that business. And in even rarer cases, like Warren Buffett through Berkshire Hathaway, these letters actually provide some investing analysis tips and principles that we can personally use when looking for investments in the stock market. Before we get into the letter, I do want to give something back to my audience, and I haven't done one of these in a very long time, so I'm super excited. But I'm going to be doing a giveaway of 5 copies of the book, The Essays of Warren Buffett. So until the end of February, you can enter using the link in the description below and enter to win one of those 5 books. And for those who don't know what this book is, it's basically a summary of all of the investing principles that Buffett talks about in his letters to the shareholders. So this book is completely appropriate as we start this new series. So use the link if you want to check it out. Basically, you just need to enter your email and then make sure you're subscribed to the YouTube channel. And then there's a number of other ways that you can get some extra entries if you want. But that's available for you if you want to enter. But with that said, let's jump into the video. The first thing that Buffett talks about in this letter that is really valuable for long-term investors is his discussion around the importance of the figure return on equity. He first talks about how most companies will be really happy if they have what they call a record EPS year, where earnings per share has reached a record high. And he basically says in the letter that we find nothing particularly noteworthy in a management's performance combining, say, a 10% increase in equity capital and a 5% increase in earnings per share. After all, even a totally dormant savings account will produce steadily rising interest earnings each year because of compounding. He explains how businesses run by terrible management teams can see increases in their earnings per share or record earnings per share, and that is in of itself no real achievement. What is a real achievement is comparing the growth of earnings or the earnings figure itself to how much capital was required to be invested in order to produce that amount of earnings, right? If a company produces $1 billion in record earnings, that sounds great. But if you find out that they had to take on $50 billion in debt just to make an additional $1 billion in earnings, then all of a sudden that $1 billion doesn't sound so good. And Buffett explains what we are looking for as investors. So he says if we exclude companies with really high levels of debt or unrealistic balance sheets, then you essentially want to find a company that is growing their profits, but also maintaining a high return on equity. as a consistently high return on equity is a good indicator of managerial economic performance. For me personally, I don't actually look at the return on equity, I look at the return on invested capital, but I am looking for businesses that have pretty much no debt. And for companies that have no long-term debt, the return on invested capital is the exact same as the return on equity. So while I am looking at a different figure, for the businesses that I'm looking at, which are no debt or really low debt companies, I'm basically looking at the same figure that Buffett suggests we should in 1977. The easiest way for you to calculate this for a business is to use my free analysis spreadsheet. You can download it via the link in the description below. You just enter in the data that is required and it will do all of the calculations for you. And there's really a couple of main things that we're looking for when we're looking at the return on equity or the return on invested capital. The first is that we want this number to be consistently above 10%, indicating that the business is generating double-digit returns on the cash that they're investing within the business. We want this number to be either stable over time or, in the best case, increasing, as showing us that the business is getting more effective at investing capital within the business. We want to see this figure higher than competing businesses, showing that their investments are better than their competition. And we want to see that equity is growing while the ROIC is stable or increasing, which basically shows us that a company can consistently reinvest and compound their profits at a high rate. The second principle that I took away from this 1977 letter to the shareholders was his discussion around tailwinds and headwinds when it comes to investing in businesses. And Buffett shows us this by using his businesses as an example, as he has one distinct business in 1977 that has significant tailwinds. So the industry is pushing up behind it, allowing it to grow at a high rate. And he has another business that has significant headwinds, which is preventing the business from growing. These two businesses for Berkshire Hathaway in 1977 were the insurance business, which had grown by 600% for Berkshire Hathaway over the past decade, and the textiles business, which was consistently declining over time. And in the letter, he indicates that a significant portion of why these two businesses have performed so differently is because of the trends in the industry, one being a tailwind and the other being a headwind. In their insurance business, he notes that they made many mistakes while growing and starting new insurance businesses across the US, but the business was being pushed forward by tailwinds in the industry, such as increasing demand for liability insurance. At the same time, Buffett believes that even with their great management team running the textile business, the shrinking industry in the US made it challenging to produce even moderately good results. In the letter, he says that this shows the importance of being in businesses where tailwinds prevail rather than headwinds. And I personally use this principle when I'm analyzing businesses and looking for potential investments, because I am looking for businesses that operate in industries that are likely to grow or continue growing in the future. Think of it this way. If an industry doesn't grow, so in other words, the revenue in the industry for all of the businesses is the same every year, then in order for a company to grow revenue within that industry, it needs to steal customers and therefore market share from competing businesses, because there is no new revenue coming from the industry growing. However, if the industry is growing, so in other words, revenue is increasing year to year, then even if the business just maintains its market share, its revenue will go up. And of course, if an industry is shrinking over time, like the textile industry was in 1977, then even if the business gains market share, their results or their revenue may remain flat or even decline. In the letter, Buffett goes on to talk about something that he brings up in almost every single letter to the shareholders, and that is the 4 key investing principles that he has always been using or has used for a very long time to identify really, really sound investments. And those 4 principles that you've heard from me many, many times on this channel are a business that he can understand, favorable long-term prospects, or in other words, businesses with distinct competitive advantages, an honest and competent management team, and a stock that is available at an attractive price. He goes on to say that we ordinarily make no attempt to buy equities for anticipated favorable stock price behavior in the short term, which is just a fancy way of saying he doesn't speculate on what a stock will do in the next few months or even over the course of a year. In fact, if their business experience continues to satisfy us, we welcome lower market prices of stocks we own as an opportunity to acquire even more of a good thing at a better price. And while for my audience here, the people watching this, that may seem very, very obvious, unfortunately, it's not the way that the vast majority of people are investing in today's market. Especially if you look at YouTube these days, it's kind of sad how clickbaity videos have become. My homepage is just full of these rubbish videos with titles or thumbnails that say stock that's going to 5x fast, or this is the next 10x stock, or this stock's going up 1000%. And that has absolutely nothing to do with the core principles that have made the most successful investors very, very wealthy over time. These businesses that you will see in these snappy videos that are supposed to just get your clicks so that they can make a bunch of ad revenue, those videos are usually about brand new businesses with no track record. They're usually not profitable. They're usually in obscure, weird industries that most people won't understand. And there is usually zero consideration about the management team, about the people who are actually running that business. It actually makes me quite sad to see the direction that a lot of investing content has gone on YouTube, and I absolutely flat out refuse to make videos covering businesses that are expected to 5x over the next year or so. It's just not something that I'm going to do. I will continue to talk about Warren Buffett's core principles and some businesses that I've analyzed that I think are really sound long-term investments that probably not going to 10x over the next couple of years, but they will likely provide some very solid, safe returns over time. But that's all we had for today's video. That's all of the principles that I took out of this letter. I will be covering other letters in the future, and if that's something in particular that you would like me to do on a week-by-week basis or however often, make sure you let me know down in the comment section below. Leave a like on the video. That also shows me that you enjoyed the content, and it shows YouTube that you enjoyed the content, and hit subscribe if you want to join the team and get up to date when content is coming out. But other than that, hope you guys have a great day, and I'll see you in the next video.